Hello, I'm Richard Mize, real estate editor for the Oklahoman and NewsOK.com, talking with Mike Buhl of Commercial Realty Resources Company in Norman, but he works metro-wide, statewide, and into Tulsa, correct, and into Northwest Arkansas,
correct,
in multifamily sales and investment, and that's apartment buildings and complexes. Mike has just finished his year-end report for Oklahoma City and Tulsa. That's what we're here to talk about. So take off. What's the highlight or the highlights of your report, your observations for 2015?
Well, the first thing is always look at the numbers, right? I mean, did the market go up? Did it go down? Right. The simple numbers are simply, I'll just refer to the report I did. Total sales volume for 2015, it was up 60% from 2014. Total units sold up 37%. And the numbers kind of just keep going on. You know, average price per unit was up, number of transactions were up. So what it says is, I mean, the market's still very, very strong
it's
right now.
Up, and it has been for about 10 years?
It's at least 8, yeah. I mean, you know, to some degree, yeah. 10 years is, you know, I often refer to that. It's the best it's been in decades, really. It's, you know, there's a lot of factors that play into that. Primarily, I think that you look at interest rates is one of the biggest factors. And here's, I was talking to somebody the other day, and if you look at fair market value, okay, I mean, it's simply, you know, fair market value should simply be if you sell your property and I buy your property, then that's the value, right? That is the fair market value.
Yes.
Technically, as long as neither party is unduly motivated, right? I mean, you're not pressed to sell and I'm not pressed to buy. Typically, in the past, we've looked at that, and I think that 1031 exchanges have been kind of that thing that has motivated buyers.
It's lubricated transactions that wouldn't necessarily have happened at all.
Exactly.
Right?
Now I think that we've pressed that level of fair market value because of interest rates. I think because buyers have to some degree become unduly motivated to try to take advantage of these low rates. And I refer back to a couple of people that I've talked to, buyers, that have said in the past that the market's not going to change. There's nothing that they see in the market that's going to make the market go down. It's going to keep going up, and interest rates they're not going to go up. And one guy even told me they don't think that we'll see interest rates go up in my lifetime. Well, now you see the effects. I mean, it's a cause and effect, right? I mean, we've seen that the cause, okay, oil prices and new construction coming to the market, but we haven't really seen the effect of that. The market's still going strong, and I think we've kind of lulled ourselves just to believe that it's just going to keep going well.
It's generational. It's generational, whatever you're talking about in terms of investment and speculative buying. Oh, it's never going to fail.
Right.
It's just one generation to the next. Maybe we're at that part of a generation where it's like, well, they don't know because they don't know and they don't believe the history of the old newspaper stories.
Right.
And so until it hits.
Exactly. And so I think that now one of the points of my report is just simply, I think it might be time that we start to look at the effects. Are there going to be some effects of all the new construction that's come on the market? The effects, even though interest rates haven't moved a lot, you know, 1/4 of a point, but the point is they're going to start moving back in that direction. They're not going to stay low through my lifetime, as some people might have said. So there is going to be an effect. Now, and this is what I tell people, today the market's great. You know, is it going to be that way tomorrow? Probably. At some point, we will start to see some effects. Now, and the thing that I point out in here,
you see a tapering off, not a cliff.
Well, that's exactly right. And I think you kind of read the national reports, and people want to talk about bubbles and is it going to pop? We're not going to get to that level, in my opinion. I think here's where I think is going to happen. Instead of the market continuing to go up, 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 I think it just levels off, okay? And that's not a bad thing, but as I point out, for some, the fact that the market's not going up, up, up is going to have the sensation of the market going down, right? I mean, if you bought a property with the projections that your rental rates were going to keep going up and they don't, then that's going to be a problem. Now, is it going to be a problem to the point that we see foreclosures hit the market? No, it's not going to hit those kind of levels.
Let's reiterate that again. A large part of what, and the most part of what an investment buy is for income, it's income. And so if your pro forma is based on rent going up however much percent per year, and it flattens out, you've made a miscue on the front end.
Right.
Right? I mean, because you're not buying that building because of the intrinsic value of the bricks and mortar and the swimming pool. It's the income that you derive from it.
Exactly.
I just wanted to point that out because that's lost in a lot of discussions among folks that don't look at this stuff every day like you do.
Well, exactly.
And regularly as I try to.
True. And some of that even gets back to the buyer profiles as well. If it's an individual buyer who's buying this one property I just sold, was a family partnership that bought the property. They look at long-term ownership, and they're more concerned about what happens with that. You know, they're looking at, instead of a 10-year mortgage, they took out a 12-year mortgage just so that they have a little bit more cushion. When you look at the other side of the buyer profile and we see these REITs and these large syndications coming in buying properties, a lot of these companies have big portfolios, and so this property just gets blended in with this big portfolio. And I'm not picking on REITs, but REITs as an example, one property or two properties in Oklahoma City or wherever it may be in this big portfolio, let's say that the market does correct and it goes down some, and instead of $120,000 a unit, it's now worth $100,000 a unit. They can afford to sell that and take a loss, and it just gets mixed in with the whole blend, right? I mean, the REIT, it's a share price, so maybe the share price dips a little bit, and then they go buy a property somewhere else, and the share price, and it just gets...
Well, that's diversity or a basket of goods or whatever. I mean,
right.
That's why you do what...
Well, exactly,
that's why you
but
mix things
those
up.
buyers are able to pay more and take more risk in the market because of that fact than some individual type buyer could. So I think we've seen a lot of that happen in the market as well. We've got a lot of investors who have raised money. REITs especially, they raise money, they have to spend that money. They're not going to turn around and give it back to, you know, investors who put that money with them. So they have to buy product, and they've taken advantage of this interest rate environment. So I think a big part of that has driven this market, caused these values to go up, caused our transaction volume to go up, and you know, and it's pretty, I mean, just refer to it, I mean, it's pretty record numbers. When you look at 2015, there was 436 million in sales volume as compared to 272 in 2014. You know, and the number of units sold was 8,379 compared to 6,100. So, you know, the numbers are pretty substantial where the market's going.
Let's look under that. Let's look at the money within the money and where it's going. You pointed out also that last year there was more volume in the 90s era, the newer properties, than the others, which was different from the year before. In the past couple of years, you and I have talked about value-add investors coming in and buying the mid-price properties, knowing they're going to put money into them, to turn them, to reposition them, to increase the income, and then they either to draw on that income or to turn around and sell them.
Right.
Well, that's not gone away, but wasn't the predominant deal last year, was it?
Right.
Why did that change, do you think? Well,
I think, and here's the thing about those numbers, it doesn't take a lot to totally skew the numbers. For instance, you know, the Avana deals sell, and it's $70 million worth of product.
Name those properties. It's the Avana. There's 4 of them.
Well, there was only 2 involved in this sale. In the most recent deal was Avana 3131, which was down off 89th Street, South Oklahoma City, and then Avana on 2nd Street in Edmond. Right. Those were the 2 that were involved, which again brings back to, not to get off that point, but the buyer of that was BlackRock Real Estate, which is, you know, they're like the biggest ever. Okay, so they're buying in Oklahoma City,
and they bought it from another of the biggest ever.
Well, exactly, right. So that says a lot about the market and the perception of where we're going. But back to the point, if you look at those 2 sales, that category was running about a little less than 100 million, and then you get 2 sales like that pop you up to, now we're at, you know, 160 million in that. So it doesn't take a lot in those newer products to move that average up. But those are two properties that are highlights. When you look at the price per unit, which was roughly $109 a unit, 2 years ago they sell for, I think it was 103, or whatever the number was. It was more now than it was 2 years ago. So it shows that the buyers are believing the market's continuing to move up. You get large companies like that are putting money into Oklahoma City. So that's another big thing. So those sales, they say a lot about the market. And then it's always a trickle-down effect. The 80s type products follow suit. We've seen those come up. We've seen a lot of investors, Warwick as an example, that they buy that property for really a pretty phenomenal number and then put dollars in on top of that to renovate the asset. Another one that just sold was a deal called Esplanade, which was a 136 unit, 70s vintage property that sells for 60 a unit. So pretty substantial numbers compared to what we're used to seeing. But I think it just shows where the Oklahoma City market has gone, and I think it's going to continue that way for some time, but I do think that the cause and the effect, we're going to start to see more of a leveling off as we get into 2016.
And then there's the gorilla in everyone's living room, and it's in every living room when it comes to business in Oklahoma City right now, and it's that oil gorilla, that crude oil price gorilla, and not only job losses, but just the combined effects of cheap gas and increased buying power on one hand. And then, you know what? If you've lost your job, there goes all your buying power.
Right.
And then the effect on the economy as a whole. How does the gorilla look to you from the perspective of a broker of multifamily investment?
Well, and again, I highlight that as well. The property that's most at risk for that is new construction, Class A type properties. Those properties are the ones that are, they're going after a segment of the market that can afford to pay $1.20 a square foot or more in rents. Okay, those people have to have good jobs to pay that kind of rent. So you take markets like Moore, South Oklahoma City, that pocket over there, there's a tremendous amount of new construction that's come into that pocket. Those properties are most at risk because of job losses and oil-related effects of the market. When you look at the next level down, if you have a job and you've maintained your job and gas prices are going down, you have more disposable income in your pocket. Okay? You're actually kind of liking this, right? I mean, you got a little bit more money to spend. There's owners in that segment of the market that have capitalized on that as well, where they're improving their property and they're raising rents and they're getting it. Because it's a different segment of the market. And when you look at, obviously, if you're going to look at like a mid-80s property or a 70s, that area of the market's not expanding. The product is what it is. The inventory's there. The new end of the market is the one that keeps growing and adding, and then those new construction deals have to better the next guy to some degree to attract that tenant and get the rent. So I do think there will be some leveling off. Now, again, I don't think it's devastating type numbers. I think that when you look at some markets that have typically been 95%, maybe now they're going to be 90 or 91, and maybe instead of getting $1.20, they get $1.10 or 90-cent rents or something. So the effects of it aren't going to be huge, but the fact, I guess, that I try to get across is, I think we have to be cautious of the continual up in the market and position ourselves maybe a little better for some leveling off period in the market, which again is not a bad thing.
Leveling off, not a cliff.
Correct.
That just summarizes it.
Well, I think that's a great way
to put it. Right. We have to do, something has to give. Right. Well, 10 years from now, we'll be having the same conversation over 20 years of that can't sustain.
Right, exactly.
Anything to add?
No, I think overall, I just want to say the market is extremely healthy right now. One thing, I guess, just to point out real quickly, because I talk about expectations a bit, and just to kind of clarify a little bit about expectations in the market, what I mean by that is, when you take a property, let's say Warwick, and it sells for $73 a unit, the guy around the corner or down the street that owns a 70s vintage property he's going to think his property's worth $73,000 a unit, right? I mean, if your neighbor sells for a high price, you think your house is worth.
That's what comps are for.
That's exactly right. That's what I'm talking about, expectations. I think maybe we have to get to a point where seller expectations adjust a little bit and we realize, okay, maybe I'm not going to get 73 a unit. There were things about a property that cause it to get more than the next one. And as long as sellers keep their expectations right, the market's still great for sellers to take advantage of where the market is. Maybe it's a sale that they wouldn't have had a couple years ago. Maybe the property can bring more now than it could have a couple years ago. So those are advantages that they can use in this market. So that's what when I talk about expectations, I think that if sellers view it from that point, there's still a lot of movement in the market.
There are some connections between multifamily and single family, and that's kind of one right there. Just the notion of comps and what they mean and what they really mean.
Correct.
And when you really drill down into those comps, well, why is that outlier an outlier? Well, because of the granite.
Well, exactly.
Because it's got an in-ground pool or whatever.
There's always properties that are special in certain aspects, right?
Mike Buhl, Commercial Realty Resources Company. Thanks for joining us. I'm Richard Mize, real estate editor for the Oklahoman and NewsOK.com.